Okay, as we told you, two stocks are on, the brokerage radar today. VA Tech Vibhag is actually up almost 5%. That and Dilip Bilkon, both of those stocks buzzing on the back of Nomura's positive commentary on these companies. Let's go across to Nimesh and find out what the revised price targets are and why this brokerage is positive on these two. Nimesh.
Hi, Survis. As you rightly pointed out, Nomura is positive on both these stocks, and hence there is a bit of an uptick there. So on VA Tech Vibhag, they have a target price of 446, which is a 82% potential upside from yesterday's closing price. Now, financial closure of HAM assets and a strong order book provides visibility according to Nomura on VA Tech, and the fact that the company is generating enough cash flow in FY20 and first 9 months of FY21 means that they are addressing the debt concerns as well. And at a relative valuations of 7 times FY23 EPS of 34 rupees, the stock is attractive, and hence they have a very big target in VA Tech Vibhag, which is 80% upside from current levels. As far as Dilip Bilkon is concerned, Nomura has a target price of 810. Again, there it means a potential upside of close to 48%. The key reason for the upside is the diversification which the company announced recently. So they're getting into the MDO coal business as well as the railway freight business. Both according to Nomura, are strategic in nature, and this will add to the revenue stream as well in the near to medium term. Only from the MDO business, Nomura expects an annual cash flow of close to 240 to 270 crores for Dilip Bilkon, and with asset stake sale, there will be further deleveraging as well. So, on back of both developments, they have raised the target price on Dilip Bilkon as well as VA Tech Vibhag.
Okay, thanks for pointing that out, Nimesh. Yes, both these stocks are doing really well. So let me take it to Dilip. Dilip, let me start with actually Dilip Bilkon, 7%. Typically, the market gets very worried the moment there is business diversification announced. Here it's from roads and highways to coal. Your thoughts on the stock?
Very difficult to take a call on this because early times we do not know how this is going to really pan out. But certainly, I think I would be more interested in the infra business because this budget has made it very clear that it's going to be infra all the way, not just for this year, possibly for next couple of years. And that should put the spotlight on a few good infra companies. And maybe Dilip Bilkon is one of the few companies which really matches up to the bill. And I think that is where possibly I would take a bigger bet rather than on anything else. So I think maybe from the current levels, more important is whether they will be able to hive off some of the assets and monetize it. Well, that remains a question mark that not going to be easily answered. But still, on an overall, considering that infra is going to be good, I think Dilip Bilkon is one of the few companies that qualifies and meets the bill. So I would say it looks possibly pretty good from the current level.
Okay, well, the market's seeing some recovery. It's palpable now, especially on the bank Nifty from the lowest point, and on the Nifty as well. It's visible. Dilip, I have one last question for you, but before that, you may want to hear out the Tata Motors Management. Now, what this issue of semiconductors has been bothering some of the auto stocks. So let's hear out Tata Motors Management on this and a couple of other issues as well.
The semiconductor issue which has hit the auto industry globally, and this is going to remain a challenge for 4-5 months, and we are trying to somehow manage the supply chain and avoiding any loss in the supply. So far, we have not got impacted by making certain adjustment, by making certain alternate arrangements, by at times going to tier 2 level and directly buying the semiconductors to protect ourselves. We have given advance schedules to the semiconductor suppliers, which typically we used to give for 6 months. Now it is firm schedules for 12 months. So there are many adjustments that we had to make. But definitely semiconductor is one area which remains uncertain for the next 4-5 months is what we are clearly seeing. It is not going to go away that fast.
Okay, that's an important point, Dilip. He said that it's not going to go away very fast. It's going to take 4 to 5 months. And we know that right now it's been a bit of a purple patch for Tata Motors. Do you think this issue can sort of puncture this rally?
Anuj, I don't think that this particular issue can really impact its momentum. But clearly, some of the auto stocks and most of Tata Motors have clearly had a very good run without any let-up. So I think that is more important. And whether I think in terms of the volume numbers, which market is extrapolating as going to be a very exponential kind of movement in terms of volume as compared to the previous year, But maybe this trend, as has been indicated in the last couple of months, whether that will continue, I think that will really decide whether, in terms of the passenger vehicles as well as in terms of CVs, whether its growth momentum is going to remain or is here to stay. And that will decide possibly how Tata Motors will fare, in my opinion.
Okay, Dilip, we'll leave it there today. Thanks a lot for joining us. Time now to invite our Alpha Manager for the day, Pramod Gubi, co-founder of Masterless Investment Managers, is now joining us on the show. Pramod, good afternoon. Thanks for joining us. The market's been, worried a bit about this whole bond yield issue. Do you think it could lead to a significant correction, or once again, would this be a buying opportunity?
Well, I think we need to understand why have the yields gone up, right? So I guess in the normal case of an economic recovery, yields are bound to go up as long as it is driven by better demand and so on. It's fine. I know we are living in a stage where we have an additional issue around the fiscal deficit and the government's own borrowing program, which has also caused a little bit of bump up in yields, and that I think was expected. So I won't read too much into it. We're still in very comfortable territory as far as yields are concerned. If we see a sustained increase in yields, which can be a cause for worry, we'll have to look at that. But at this stage, I think it's just reflecting the fact that things are improving on the ground. And the fact that the government is going to be borrowing a lot more. I won't read too much beyond that.
Okay, so bond yields not that much of a worry for you. Pramod got that. Now let's talk about the other worry, the fact that, we thought this COVID situation is completely over for India and we're all going to be vaccinated and then it's going to be a thing of the past. At least the numbers out of Maharashtra aren't inspiring that same level of comfort right now. Is that a worry?
Yes, indeed. I don't think you can brush that aside. The rest of the world has gone through a fairly steep second wave. We've been lucky so far that we haven't seen that. If indeed these rise in numbers are a suggestion that there could be a second wave in India, which could result in far broader lockdowns, which again hampers economic activity, I think it is a cause for worry. I don't think you can look beyond that. Beyond that, I don't think I have any better idea about what's happening on the ground on this front. The only thing we can do, we at Marcellus do, is be prepared for such adversities. And the recent times have told us that these adversities can come from any direction. As long as you're invested in fundamentally strong companies, you can expose yourself to a potential economic recovery. It's not like fundamentally strong companies don't perform well during a recovery. But at the same time, you can protect your downside should such adversities rise. Beyond that, I don't think any of us can second guess the nature of these rise in COVID cases and hence what should be a market call.
Okay, fair enough. So in that case, let's talk about how investors should approach this market from here on. I see consistent compounders, of course, stocks like Asian Paints and Berger Paints. But Pramod, are we reaching a stage where perhaps the valuation is just too much of a headwind, even for something like an Asian Paints?
Not really. I mean, certainly not from our perspective or not from our understanding of the intrinsic value of these companies are. In fact, even if you look at the recent rally in those stocks, they have been accompanied by extremely strong results in terms of earnings recovery. Forget about earnings. There might be a little bit of benefit coming from the cost reductions most companies have undertaken during this pandemic. But if you simply look at the volume numbers, the top line numbers, I don't think paint demand in India is increasing at the level that these companies are showing. It's clearly a case of market share gains for these companies. Paint still has a substantial portion of unorganized sector, which has faced extreme difficulties even before COVID, when India as an economy started formalizing under GST and so on. COVID has just made existence for smaller fringe players in pretty much every sector, largely in building materials. Within that, paints has its own share of unorganized players, which have clearly given way for some of these guys. So as long as the fundamentals are reflecting the stock price appreciation, I don't think there's a case for any concerns on valuation front either.
Okay. Pramod, I know this is not really so much about individual stocks. You don't talk too much on that. But I'm just going to ask you about Nestle anyway, because surprisingly enough, it's a very strong franchise, something that you've owned for a while. And purely going by Q3, there was a bit of a disappointment. And I know one quarter doesn't make a trajectory. But any concerns with respect to perhaps demand tapering off, a lot of the pent-up COVID perhaps buying, that's all over and done? Or do you think it was just an aberration and best to forget it?
Yeah, I mean, more than single stock, I mean, we are averse to looking at very